As I said, hope you had a great break. And I'd just like to also sort of acknowledge the people who maybe weren't able to be here this morning because of travel delays or other reasons and might be catching up online or watching recording. So thank you for doing that as well. The first panel really clearly laid out sort of our findings from our research. In the second panel, we'd like to talk about raising the standard for responsible lending. So this is a bit of a so what? What do we leave this session with beyond some good conversations and some energy? I'm joined I guess it's afternoon now, this afternoon, by Muna Yassin, CEO of Rooted Finance, Deanna Kamil-Salmon, Associate Director at Fair4All Finance, and Ahmed Al-Adal, Director of Retail Banking at the FCA. My name is Shakwa Tulana. I'm Associate Director of Research and Innovation at Nest Insight and the program lead on our resilience work. So we have had a conversation about the details of the research. Sorry, I'm now looking for my clicker, which I swore I wasn't going to lose. Thank you. Doesn't seem to be working. Thank you, Joe. And we've given this panel a slightly provocative title. And when we think about responsible lending and what it means to be a responsible lender, it's often about preventing harm, putting on the guardrails, making sure that the worst doesn't happen. We'd like to sort of reimagine that based on what we've learned through this research and think, what about a world where being a responsible lender isn't just about making sure the worst doesn't happen to people when they're borrowing? What if it's about creating a moment where the moment someone comes to you needing to borrow, they've opened a loan, opened a line of credit, is also the moment they've taken their first step towards financial resilience. And that might be a bit counterintuitive because you think, well, the moment that someone needs a loan is actually a moment where their resilience is potentially most at risk. We've seen the benefits of joining up savings and borrowing products. And so we think that the opportunity here is actually to turn that loan moment into a financial resilience one. Looking at what we've learned from existing models and the needs of households that we've spoken to, we think there are actually 6 places or 6 moments in the way that these products are designed that they could be optimized, not just for the moment that people receive them, but actually optimized in a way that allows them to scale and reach those millions of households that Aaron told us about earlier. So the first of these is in accessibility. And I mean that a bit generally in that people need to be able to access the products, but also about the accessibility of the savings pots that they're building. We know from what we've seen in the research that being able to access those savings is a route to avoiding more risky or more expensive ways of meeting an immediate need. But we've also talked at our table, for example, about the fact that, yes, that accessibility can make the difference, especially if you're in a sort of budget management mode. But if you're looking to build your savings or become even more resilient, is there a way that accessibility can be toggled or amended to help you meet your financial goals? We also talked about meaningful defaults. If you're putting just a little bit away, it becomes harder to build up that bigger amount. Is there something that you can do when looking at the overall picture of affordability when designing these types of products to make it possible for households to build up to an amount that's meaningful for them? Balances that help them deepen their identity as savers and also become useful for the inevitable next shock that comes. The third area we've talked about is transparency. So that idea that no one gets to be surprised by the fact that they have savings. It'd be really hard for any of us to commit to a habit we didn't know we were doing. This is why we have Fitbits and smartwatches, right? Like that heckle us if we don't get our steps in. It's the same with building a savings habit. If you don't know that you're doing it, if you don't know the benefit that it might be to you, it's hard to stick with. How can we integrate that even more so into the design of joined up borrowing and savings products? Whether you're looking to manage your household budget or save up for that big ticket item, knowing what you're working with, both in terms of your loan balance, but also what you've saved, is really important. Fourth, we've highlighted the idea of responsiveness. Many of the households that we are sort of working with and looking at don't have a salary that's the same month to month. They might pick up more shifts, they might have fewer shifts. A shock might make a huge difference to their ability to continue earning going forward. Can joined up savings and borrowing products be a bit more responsive? So when you've earned a little bit more this month, can you put a little bit more away so that you're that bit more resilient in the future? This also reduces the mental load of having to think about doing that on your own. Yeah, sure, you might be able to say, yes, I manage every penny in my household, so of course if I picked up an extra shift, I'll put an extra bit away. But a product that does that for you could make the difference between being able to save more and not in the moment that you're getting paid. Linked to this, we've highlighted the idea of empathy. One of the things we saw that our credit union partners do incredibly well, and which Caroline touched on, is to pick up the phone to their members, to recognize them and call them by name when they walk into a brick and mortar building. That's really hard to recreate, but the spirit behind it can be designed for. Can you understand what people's goals and priorities are? Can you help them celebrate their wins? And it's not just that initial win of getting started, but that win around consistency, having met a savings goal, or having engaged with a product at all. We think that this would help people who are in a borrowing and saving journey to engage more with the product overall and really see themselves as savers. And finally, the idea of ease and integration. The previous panel talked a lot about the role of friction. And we think that from that first moment, when people are opening a loan, seeing it as core to add in the savings component and not an add-on. It's not just about the well-being effects that we've talked about, but also about making sure that information gaps don't open as their loan term continues on. So I've used moderator's prerogative to share a little bit more about what we think could be done and what the potential here for raising the standard on what a good lending experience is for borrowers could look like. But I wanted to come to our panel. So you come from a range of perspectives, everything from a debt management perspective to different types of lending and borrowing journeys to a regulator's perspective. If you had to pick a place to start, if you had to pick one of these sort of opportunities to act on, in your neck of the woods, what feels most live or like it would make the biggest difference? Can I come to you first, Muna?
This is working, and I'm one of those like Erin, I have a very loud voice, so I'll keep it far away. I would have to start at empathy. So we are at Rooted, a debt advice organisation and financial inclusion charity. We support people through financial distress and crisis. And we know empathy goes a long way when it comes to being able to build trust and also ensure that people feel comfortable to make decisions, informed decisions. And so for me, I think thinking about how we move from crisis to resilience has always involved thinking about how we can ensure that people have education, people have access to good information around how to rebuild their credit, and it feels natural that savings is part of that. So I occupy a space like Vicky was talking about in the debt management world, where people have this assumption that people should pay down their debts first, and if you are in financial difficulty, why should you be borrowing, let alone saving? And I think there's something around, if we want to ensure that people have a journey out of debt, we have to think beyond debt. And so for us, it's very important that empathy is a starting point and understanding people's financial goals and current situations. But also, is there a way that we can ensure that their financial resilience is not just based on our perceptions of what good looks like? It's based on what their aspirations and what their current circumstances and their future aspirations are as well.
I really like that. I think the idea that you're seeing people on a journey through, not just in the moment. So empathy isn't just this touchy-feely thing of being nice to people for the sake of being nice to them, but actually it's about a more holistic view of what their potential kind of onward journey is. That's really useful. Deanna?
And maybe I can also just touch on the word responsible lending, which I think can mean different things to different people, right? A lot of time people think responsible lending is just lending at the cheapest possible rate to that customer. And I think I'd like to challenge that. I mean, price is really important. Nobody wants to see customers paying a poverty premium. But the reality is, so are the different kind of products and services and the support measures along the way of a customer journey. Those are equally as important as other parts of the kind of responsible lending journey. And that's something that we really see at kind of Fair4All Finance, and what we try to encourage lenders to do is to think about broader links to savings alongside lending journeys, and thinking about encouraging customers to take out insurance products and other ways of building financial resilience as a whole broader part of the picture. I mean, I think we've spoken a lot about different stats today around how much of a difference it can make to somebody to start saving. I guess to add some kind of lending stats to that, Experian say that there's around 10 million people with an impaired credit file. That's normally overlaid with people who are kind of low to moderate incomes. And so you've got there is people that have really complex needs. And it's not a simple answer of you just borrow or you just save. It's kind of, I guess, a menu of options to support that person into their financial well-being journey. So I guess it's a bit of a cheat to say I think all of them, but I was going to either say that or copy Muna, so I don't know which is better.
We'll allow a cheat. Ahmad?
Well, thank you first of all for the invitation today. There's a number of these that I would like to discuss, but you've asked for one. And I'm going to focus a little bit on transparency. The FCA's work on helping consumers, which is part of our 5-year strategy, is really a part of that, helping consumers navigate their financial lives. It's about building resilience, long-term resilience for individuals. The work we did last year on workplace savings is trying to build that resilience case on helping individuals at a touch point, a right touch point, start to save and long term. Transparency is incredibly important to that, because transparency is about engagement. It's about helping the customer understand what they're gaining. Someone said it earlier in the earlier panel, talking about having their aspirations, having that goal, that hit, that emotional response. So how can you, whether you're providing products or helping provisional products or helping advisors or charities, help the customers understand that those who are in financial difficulty, who are borrowing for other needs, etc., understand that by saving they are going to potentially build something here that can help them in the long term, and in doing so start a new habit. So transparency.
Thanks so much. And I think there's a through line there between that transparency and Muna, what you've said about the ways that you've worked with people who are on debt management journeys, about sort of knowing what's available to them, what their options are, and sort of empowering them to take those up. I wonder, Deanna, if you could speak to any examples in your current work that are sort of demonstrating some of the things you talked about, since you picked all of our potential optimization points. If there's any kind of good practice that you could point us towards.
I think that's fair. That's my punishment for cheating. So I think I'll talk a little bit about a previous pilot that we've run, but also a new piece of work that we've launched. So those of you that are less familiar with Fair4All Finance, we actually ran a no interest loan pilot, which is just how it sounds. You kind of borrow, but you don't pay any interest, for people that are really kind of the most financially vulnerable, but to help them get into credit union sector, to help enable them get back into kind of regulated credit. In the early pre-pilot that we did for that, which was just with credit unions, we saw a huge uplift of people who started saving, and that was fantastic, because it was people who predominantly were on very, very low to moderate incomes. A lot of them, their main form of income was benefits. That was kind of the group that we were trying to target. We saw 48% of people started saving in that pre-pilot phase of their work, which is really, really impressive. The savings amounts were small, but that was the kind of what we were trying to get to. Is I think the conversations that have been had today is sometimes it's around saving any amount that you can to get yourself into the habit, rather than getting stuck to this idea that it has to be, several £1,000s, or if that's a measure of success, and if small amount isn't a measure of success. So no interest loan scheme is probably one area of work where we've seen that work pretty well. The other thing that we're doing at the moment is, and I think as I've been sitting here today, I think what really kind of strikes me is that there's lots of really great work around savings from lots of kind of credit unions, lots of organisations that are trying to support savings, organisations that work with employers and employer benefits. There's probably a bit more that mainstream financial services can do around supporting savings and trying to enable that. And so based on that, what we've done at Fair4All Finance is we think there's probably more that mainstream financial services can do both on credit and on savings. And so we've launched a what we're calling a small sum lending pilot. Essentially, it's a pot of money to enable large banks to start serving customers that have typically been excluded. That funding is there to enable kind of partial lending guarantees, so to enable them to take more risk and to kind of test lending to customers. Because what we're finding a lot of the times is that there are really big assumptions about what it looks like to serve people on low to moderate incomes with impact credit files, but people don't actually know because they haven't done it. So a lot of the times those assumptions are kind of mythical to some degree. And so what we're hoping with this pot of funding is that it will enable the bigger banks to actually test that with our backing and our funding to support that. But what we have said is that we will prioritise proposals from lenders who can evidence that they're also increasing savings as well as borrowing, or that they're increasing access to insurance products, or they can evidence other ways of supporting financial resilience that just goes beyond just borrowing. So we're very close to announcing our first partner. I kind of hoped I'd be able to do it today, but I'll just keep you all warm so you can look out for it. We're hoping to announce on Monday our first partner, and what really stood out to us in their proposal is it's a savings linked to borrowing account. So for a customer to be able to borrow, they need to have evidence of saving. And that's a really, really big trigger for kind of customers who are really seeking credit to say, actually, I need to put a bit of money into a savings account to be able to access this credit line. So we're really, really excited to see that and to see learnings from that. But I've probably taken up more time than I should have.
No, absolutely. Useful and helpful reminder that although we looked at just a couple of different models of how savings and loans could be linked up, you've just described another where you sort of save before you borrow, and that's actually another way that might better meet certain customers' needs. So thank you for sharing. You've also raised the fact that the sort of scale of the challenge must be matched by a pretty robust response across the sector by lots of different players. So we've talked about credit unions, you've talked about mainstream lenders, and I think at our table, at least, we were really struck by the potential for scale of these types of solutions. But I'd like to take a moment to maybe ask the panel about what you think the barriers and potential watchouts are for further developing and then eventually scaling these types of solutions. Una, would you like to go first?
I think I'll come back to what Diana said about assumptions. I think there's a huge assumption that people who are in debt shouldn't be saving, which actually is a huge barrier to a whole group that could potentially be saving, but are not. Their needs are not being met. So, and I was interested to see in the report that you also had some interest in saving within debt management plans, and hearing Vicky's potential pilot around people who are coming out of debt. And this is something that we've been thinking about at Rooted Finance as well. So we're looking at ways that, coming back to that assumption thing, we know many of our minority debt advice clients from community-based debt advice organizations are actually already saving, but it's hidden and it's outside of the financial sector. So it's in community rotating savings clubs and culturally savings circles. So all of that behavior is already there, but it's just not accounted for, and it's not acknowledged, and it's not rewarded. So what we want to be able to do is work with, we have a partner that we're working with around developing a savings product that sits alongside somebody's debt management plan. And how do we ensure that people who are repaying their priority debts, so for many of our client groups at Rooted Finance, they come from priority debt situations rather than consumer debt situations. But we also know that they have the ability to save. So how do we ensure that we're working with creditors and working with institutions to ensure that they then recognise that good behaviour? And I think there is something around ensuring that, so thinking about the pitfalls and some of the barriers, I think for me, the sector's mindset. So creditors obviously expect people to pay their debt first, but the actual financial statement, the common financial statement, has a savings line. Nobody uses it, and people hide it. So what we want to do is bring back savings as a financial resilience tool that's accepted by institutions. And so as much as we're kind of working with our clients and ensuring that communities recognise the reasons and the benefits for savings, we also want to ensure that the credit sector and the financial services sector also has that level of understanding and shift in mindset as well.
There's a really practical design point there around inclusion and not doing a thing that encourages people to hide a positive behavior that they're doing as part of their either debt management or just borrowing journey generally, that I think could easily be overlooked if you sort of don't know that about customers. That's a really helpful point. Deanna, what would you say in terms of barriers, potential watch-outs?
It's a great question. I think it's sometimes that maybe we feel that it has to be one or the other. So like we're going to focus on a credit product, we're going to focus on a savings product. Again, this is a reflection from spending a lot of time with kind of mainstream financial services industries. You often have very siloed departments, so it's almost like they don't communicate to each other. And it's been really interesting to identify that and kind of be able to call it out a little bit to say how can we work more between different products and making that link of well, if somebody, as you said earlier, if somebody's paid off their loan and they've still got that kind of cash available, could they continue to save? I also saw really interesting examples of some interesting things some fintechs are doing in the US, where you've got all types of kind of sweeping products where if they've identified that you've spent a little bit less this month, they might say to you, do we have your consent to sweep that into a savings account? So it's all around, as we've said, it's difficult to kind of form those behaviours, but if it's automated, if there are things that we can do in that way, that kind of helps quite a bit.
Those are some great examples. Ahmed, your thoughts?
I mean, for fear of actually echoing some of the comments that have been said, actually maybe it's healthy we echo some of these comments, especially coming from the FCA. I would go back to, Erin put a wonderful slide up earlier that had a scale, cost versus benefits. For this to be scalable, for this to build momentum, the benefits have to be clear to the individuals concerned as well as the organisations involved. And the benefits are there. They're not always there for every single individual. So how do you build a product that is the right set of it's not singular, it's products that are there, that are supporting the right set of individuals and adaptable enough that actually for certain individuals, you may have been able to save at the beginning of this loan, but clearly you've had a life event that you need to stop saving and respond to what a life event is. So that's incredibly important, having that very clear picture to the individual so that they can build the habit, they understand what they're achieving, but also to the organisations what they're trying to achieve, and being comfortable that the cost benefit really does make sense.
Great, thank you. I think we've got time for one round robin question, and then we'll go back into discussions at our tables. And I guess I wanted to pick back up on the point about touch points, because you're each coming from quite different perspectives, and sort of what are some of the useful ways or sort of the most powerful touch points? We've talked about the moment that someone is getting a loan as being quite powerful, and that's what most of our research has focused on. But as Erin described, we're also looking at kind of midpoints and what happens at the end as well. In your sort of world and the ways that you're thinking about what these kinds of products could look like for the people you work most closely with, how are you thinking about those touch points? What feels most sort of available as an opportunity?
So from our perspective, very similar to when we support somebody through debt advice, education is not appropriate at a time of crisis, neither is talking about savings at that point. So we're working out a point where we have stabilized somebody's income, but just before the point where we're about to do a financial statement and start to think through what that budget should look like, and being able to have a conversation around, well, can we actually put in a line of savings around what that budget should be based on your current circumstances? And obviously we review those every 6 months, every 12 months, based on people's changing circumstances. So we are now in the process of kind of looking at what that life cycle and that journey looks like. We're doing some lived experience sessions, working with our clients to understand what their goals are around savings, but also actually what language should be used, what feels comfortable, how do they want that offer to look like, what would a product look like, and actually what are the types of things that they would like to save for. So then we can start to think about what does a rainy day fund goal look like, what that maximum is there a minimum? So we're at the very early stages. We're working through our lived experience kind of testing period. We're designing with our partner around what, who holds the funds, how are those funds used, how are they accessible. So we're at the very early stages. But for me, the natural touch point based on the conversations that we've had with the advisors, with clients so far, is actually beyond that emergency crisis, and then just before you set what that budget looks like, so they have some certainty around where those payments are going and who they're going to.
So it's not just a very tangible moment that people sort of have to go through as part of the debt management process, but it's also quite intensely human-centered in terms of getting down to the detail of the language being used and creating a moment that doesn't just happen because it has to happen, but that it lands and is useful to people. Deanna, your thoughts?
Again, I would agree with Mina, but actually what I would add is that I think what we found is there are a lot of really incredible organisations who know their clients way better than we do at Fair4All Finance. So the way that Mina talks to her clients and the way her team talks to their clients might resonate really differently if someone else tried to do a different approach. So I guess I will say this from the perspective of Fair4All Finance being a funder of kind of credit unions and other organisations, is that we are not going to tell you how to do things. You know your customers better than we do. But what I think has been really evident today is that there's lots of different ways of doing this. The most important thing is that you do it. I think that's really the key message from probably from us in terms of trialling different ways of getting customers to save and not just having those myths and assumption that because they're in debt, it means that they can't save, or because they're on lower incomes, it means that they can't save. So yeah, the message is just, I guess, go out and do it and tell us what works for your customers and your clients. Well,
tell them. And a final word from you, Ahmad.
I mean, I'm not. It's not here for me to say what the right touch points are, but I do agree with what's just been said by Diana. The touch points may vary. The right touch points may vary for the individuals concerned and for the organisations and how they interact. What's incredibly important is to recognise, as you do better than I do, I suspect, that individuals are not necessarily always engaging. We know they're not always engaging on their financials. They're not worrying about their financials up until it blows up, right? And therefore, how do we get them to be engaged earlier on? How do we get them to work out when they can talk about preventative, when it's okay, if it's too late, it's no longer preventative, it's about actually responding to that crisis, but then building a resilience from it. So using the different opportunities that exist when individuals are engaged and they're asking the questions and they're asking for that help.
Thank you. I think that's a really great note to end on. Been informed that we won't actually be able to have discussions at the table, but we will be able to have discussions around coffee afterwards. So I will shortly invite Will up to close the day, but I just wanted to again thank the panel and thank all of you for being here. On your way out and on your tables, I think there are QR codes for you to scan. We're really interested to know where you would start with these. I think the panel discussion was sort of coming at many of these things from different angles and with a few different examples of customers or members or clients who might be having quite different experiences. We'd love to see your responses to our little poll to see where you would begin first, and that might be where we pick up some of our conversations next time we convene around this. But that's all from us for now, and I'll invite Will to close our event.
Look, I mean, we've just got a couple of minutes for me to leave a couple of kind of final reflections and then say a few thank yous. And for the reflections, I just want to go back really to the start of the day and to some of what Vicky said. Because what came through really clearly in what she was saying to me, and I think that then was followed through in some of the discussions later, is that just recognising that kind of debt and savings are just deeply interconnected things, right? And so we can't think about them separately, whether it's just the act of starting saving or whether it's starting to build an actual savings balance, and whether that's £500 or £1,000 or £2,000. These things can materially improve people's financial health and reduce debt risks. The other thing that Vicky said that really, I mean, it's kind of obvious, but it really stuck with me was, look, kind of people's financial vulnerability, bad stuff happening to people doesn't stop happening just because they're already paying down a debt, right? And so this idea that, well, if you're paying off a debt or you have a debt, you should prioritise paying that off before you're also able to kind of build different and more sustainable kinds of resilience through savings, kind of just doesn't quite hang together. And so this idea that possibly the thing I love the most about the report that the team's produced, which I'm just super proud of, I think the team's done an incredible job, is where it says that co-holding debt and savings is not irrational. It's both a common and in some ways quite sophisticated financial management strategy. And if we kind of recognise that, we recognise that we all do it, right? Lots of people right up and down the income distribution co-hold debt and savings. Leaning into that and figuring out how we can make that work in a way that is sympathetic to the realities that people face, as opposed to kind of building against it. That's what I hope this conversation has been about, and the last panel there was great in starting to move us on to thinking about kind of what does doing this really well look like. So look, I found it to be a really fascinating conversation. I was one of the people who, with Martin at the back there, who got stuck trying to get here from Brighton this morning, so I was a couple of minutes late arriving, but it's been a great discussion, and thank you all for participating in it. And I hope that you've taken away some further food for thought. That's really what we want to do with producing this kind of work. So I'll finish this with a couple of thank yous. Firstly, to the community, amazing community of partners who we've worked with to deliver this work, be that the credit unions, Stream Salary Finance, the academic partners we've worked with, this whole kind of community that makes this kind of research possible. Secondly, to our funders, and especially to JP Morgan Chase, whose partnership with us on this work has made it all possible, and we really appreciate that. And we feel very, very excited and proud about where this work could take us next. Thirdly, to all of you who've taken time out from your days to spend time with us talking about these issues and listening to what we've had to say and what the panels have had to say. We know you're busy, but it's an incredible room. It's great to have this group of people together talking and thinking about these issues. And fourthly, and really importantly, just to the team in Nest Insight who've worked on this project, it's a really, really fascinating and powerful piece of work. Erin said, please go read the full report. We've left you with the short versions, but there's loads more depth and detail in the full report and more to come in this area from us as well. And finally, just to reiterate an ask that has come across a couple of times during the day. If you would like to work with us, if you'd like to talk to us, feedback on what you've heard, give us your own ideas. If these are areas you're interested in doing further work on, please do come and talk to us today, the various members of the Nest Insight team around, or get in touch with us afterwards, because this is an ongoing area of focus for us, and we think there's a lot more that can be done. And I think that brings us to a close. So I'll just invite you all to stay if you can. There's coffee and more refreshments outside. It'd be great. We didn't quite manage to get the table time in at the end there, but great to pick up some of that conversation in the networking afterwards if you're able to stay with us. And thank you all very much.